Welcome to Sonafan Leadership Academy, where we unlock the challenges to building sustainable business success. In this platform, we inspire business leaders on leadership practices that enable them to identify factors of business failure, how to prevent them, and provide them turnaround strategies that enable them to get their failing businesses back again on track. Join us in today's program, Small and Medium-Sized Enterprise Business Failure Inside the Experience, with one of our guests, who is a financial advisor and an accounting consultant in PTN Advisory. Mr. Teku Frank is now having you on this program.
Thank you, Mr. Sonafa.
So on today's program, we are going to be looking at cash flow analysis and how it affects small and medium-sized enterprises and can cause failure in their businesses. So we'll have you on today's program in order to enlighten us on the importance of cash flow analysis and how cash flow analysis can help small and medium-sized entrepreneurs to identify factors of business failure so as to prevent their business from failing.
Thank you, Mr. Sonafa. As you well said, I am a financial advisor. So as to what concerns matters related to cash flow, it is very important that we should try to first of all define the context of what cash flow analysis is for the easy understanding of the managers of these small and medium-sized enterprises. Okay. So in simple terms, we can simply say that cash flow is simply the money that comes into the business as compared to the money that goes out of the business. Okay. This money that comes into the business can come in various forms, such as payments from clients, such as loans that are being obtained, such as the proceeds from investments, and on the other side we have the cash outflow. Cash outflow is really what makes money to leave the business. It can be rent, it can be salaries, it can be payment of suppliers. So at the end of the day, you may have a positive cash flow on the paper, but still yet making a loss. I think that is what brought us here today.
Yeah.
Okay.
So Mr. Teku Frank, we would like to know from you as a financial advisor, in your experience, have you had any clients suffering from cash flow problems, and what was the experience there?
Yes, I have had a lot of clients that are suffering from cash flow problems because, as I earlier said, on the paper you may have a positive cash, but once we do the inventory of this cash physically, we notice that there is a mismatch. This mismatch at times is due to the fact that some entrepreneurs have long-term payments for customers and suppliers. Okay. It implies that when a customer will come and sales are being made, they will generally grant to customers the possibility to pay maybe over 60 days, maybe over 90 days. That's talking about, for example, purchases and sales of local commodities, okay, maybe for small retail stores, even for the medium that deal into maybe import and export, sales in retail or sales in larger quantities. At times they permit these clients that come the possibility of buying in larger quantities, and the terms of payment are generally not favorable to them because they want to sell out their stock fast. But on the other side, these people that are supplying to them, who are, as we know, their suppliers, these suppliers which may be from abroad, especially those who are dealing into local commodities such as clothing, such as shoes. Most of their suppliers at times are in China, so they will always buy and settle cash with a maximum at times of 1 week delay. But on the other side, with their clients, they will permit some clients to pay after 45 days, after 60 days, after 90 days. So it makes that on the paper, once you are controlling their cash, you will see that sales were made. Now, purchases were equally made. Purchases have been settled, cash. But on the other side, the sales that were being made, the clients have not paid on time. So when there is need to reorder, they notice that they don't have cash. That is one of the reasons of the failures of small and medium-sized enterprises as to the management of their cash. Another major factor that we don't talk about it enough is the fact that some business owners usually do a confusion between the cash of the business and their personal cash.
Okay, that's very important.
Yes, this is very important, as you said, because many businesses do not know the limit between what belongs to the owner and what belongs to the business. This is generally because they have one bank account. At times even they don't have any bank account. So they will do their day-to-day operations, and whenever there is a need for money for their personal reasons, they will go into the business and withdraw money which is being withdrawn and never paid, for the fact that they will say they don't have a specific amount of salary that they pay to themselves. Whatsoever they need, they'll just pick from the business, handle, whether it has a positive impact or a negative impact on the business. They will not look at it in the long run, but on the short run.
Is it that they don't have accountants that can be able to advise them? Because from the accounting point of view, I believe they will say there is no respect of the business entity concept. We say that the business has to be separated from its owner. So is it that they don't have accountant, or they don't want to take advice from the accountants to be able to bring in this separation in order for them to properly manage their cash in order to avoid some of these problems?
That's a very good question in reality, Mr. Sona, because many business owners who are found in the category of medium size, I precise medium size, because most often the small size enterprises, they will generally complain that I cannot yet afford myself an accountant because the business is still small. But most, if I may say, according to my own data, 75% of those in the medium sized entities have an accountant. Okay, but this does not stop them from withdrawing money from the business, because there is a difference between what we know from theory and the realities of the field. Okay, somebody who employs you will order you that give me money. Somebody who employs you, irrespective of how pertinent the advice that you bring to him may be. Okay. Because at the end of the day, he will tell you it is the risk that I take from withdrawing this money and doing several different activities that generate in return the salary that I pay to you. So on the other hand, you cannot withhold yourself from giving him his money. So at the end of the day, you will notice that the accountants that are recruited in these small and medium-sized entities may be as competent as they can be, but at the end of the day, who has the final decision on the cash flow of the business? It is the business owner.
Do you not think that this, what you have just explained, is one of the major problems? Because research have actually pointed out small and medium-sized enterprises are failing huge within maybe 5 years of their operation, and they are pointing more fingers on cash flow. Yes. Do you not think that is because of this reason that they don't listen maybe to their accountants, or they don't have a proper structure within which they can be able to rely on certain advices from their accountant, so that they can be able to reduce some of the rate of this mismanagement of cash in order not to lead the business to failure?
Yes, Mr. Sona, I think that a lot of business owners fail because they don't follow competent advices. But on the other side, we should not only push the responsibility of these failures on the business owners. As I said, the realities of the field. The realities of the field will warrant that an accountant is not necessarily a financial advisor. Okay, you should really put the difference between a financial advisor and an accountant. Okay. Once an accountant comes, and more especially in Africa, in the African context, before doing the difference between a financial advisor and an accountant, we don't even do the difference between an accountant and a bookkeeper. Okay, because most of the people who are being recruited in the African context, okay, are being called accountants, whereas they are bookkeepers. Okay, they just come in, they take what we have as expenses, they record it into the system, they take what they have as revenues, the record at the end of the day, they generate the difference, which is a result, and that is what is of interest to many business owners. They stop there. An accountant on the other side will push further his analysis.
That's a financial advisor.
An accountant first.
Okay.
He will push further his analysis after the records. He will go, has the results that you are presenting, do they reflect the realities of what we have in our books? At times, a bookkeeper is just limited to booking. He will not go into forecasting. Now, that is the work of an accountant. It comes after bookkeeping has been done.
Okay.
Presentation of financial statements, analysis of these financial statements, proposing solutions and ameliorations to the management. The financial advisor, his own work comes after the accountant. Now, after the accountant must have done this analysis, must have proposed solutions, the financial advisor now comes into place. The solutions that have been proposed, are they the best? Are they effective? Are they efficient? In a short run, can we make these solutions that have been proposed? In a long run, do they suit to the business model of this particular business? So now the financial advisor now will tell the business owner, to what has been done, to what has been crashed out from your books, is there a possibility where we can have a better budget to manage your cash flow? Because that's equally where one of the problems arise. They don't even have a budget. So how will they even know that what I am about to do will affect my cash flow in a particular way? There's no problem. You bear with me that there's no problem if a business owner takes a particular risk of withdrawing money into the business, if the money that is in the business is in excess in such a way that he can invest, and then the revenues from this investment are sent back into the business. The problem always comes where we don't have a clear visibility of our financial statements. Thereby, withdrawing this money becomes a huge problem, because after you have withdrawn the money, the expenses that are coming after, are we going to be capable of managing them? Are we going to be capable of meeting up with the fixed expenses? As I said, you have rent, you have salaries, you have some specific suppliers that are there on a monthly basis. You cannot do without internet, without water, without electricity, without personnel. So by the time you are playing with your cash flow, are you sure that what you are doing will meet up with the day-to-day expectations of the business? So that is it.
From all what you have explained, it really means that due to the lack of the financial visibility in most of these small medium-sized businesses, that is one to say that they don't first of all have the proper structuring of keeping accounts. Most of them don't even prepare financial statements. That is to say that maybe their income statement, full-fledged income statement, the balance sheet, and the cash flow statement, which is very, very pertinent, because we are talking about cash flow. The cash flow statement comes into play, because if they are not preparing cash flow statement, for example, they might not even know which part of their business is actually generating that cash that they are using. Where is the money coming from that they are financing their operations, and is it that their operation is generating the cash that they actually are using? So because if they are not preparing this financial statement, they will not be able to have financial visibility. And I think that is one of the biggest problems, because research itself is pointing finger on cash flow mismanagement as one of the killer of most small and medium-sized enterprises. So I want to ask another issue concerning cash flow management, because I discovered that most small and medium-sized enterprises, they are too fast in growing, that they want to grow fast, and that maybe cause them to finance their growth in a wrong way. That is to say, for example, they financing their growth using short-term cash that are made for short-term purposes. They finance large expansion, financing assets that will start generating in long run while using short-term cash. That is, they don't know how they can be able to manage their financial structure so as to permit them to know which cash is supposed to be used for large expansion or to buy things like fixed assets, which cash is supposed to be used for operational activities. Have you had any experience in that aspect also?
Yes, Mr. Sona. The reality is that on the field, as I earlier said, OHADA warrants that cash flow statement should be prepared by entities that fall under the normal system normal. Okay, so for you to enter inside system normal, you must be an entity that realizes a huge turnover, whereas those who are under system minimal de trésorerie, which we call in English the minimum cash system, they are not required to prepare a cash flow statement. So at the level of the accountant, since he from his knowledge does not have to prepare a cash flow statement, the business owner on the other side may not really have a clear visibility as to what comes into operating activities, investing activities, or financing activities. That is the first issue. The second issue is, as we said, most business owners want to expand too quick, and one of the inconvenience of expanding too quick when you don't have a financial advisor, when you don't have a competent accountant, is that in your rapid expansion, cash that was made to use for day-to-day operations, as you rightly said, will be used in purchasing assets that will bring in a kind of, that will generate benefits to the business in the long run. If for example you need instead to buy a bigger warehouse that will permit you to have a massive entry of stock, which will equally permit you to sell quickly, you instead go and buy a land. For example, you buy transport equipment, you buy sophisticated softwares, you are buying all of this, whereas your cash on its own does not permit you to turn the stock that you already have on day-to-day basis. You are instead supposed to focus more on activities that can generate you cash immediately. That is the first thing that you should do, and this comes through having a visibility of your financial statement, having a clear budget, and having reserves that are being kept should in case, because in the reality of the field today, there is no way everything that has been budgeted is spent according to the budget. There's no way. You always have unexpected expenses as compared to unexpected revenues. You always have more of unexpected expenses as compared to revenues. So you should prepare in your financial statement in such a way that your budget should equally include money allocated for reserves, should in case. And the last factor that we should not forget is taxes. We live in an economy where you cannot proceed with your business if you neglect taxes. One note regarding a new finance law, a new general tax code can close your business due to the high taxes that are related to certain activity sectors. So this at the end equally discourages some business owners to really invest into their business. That is one. And the second thing is that regarding taxes on the field at BTN Advisory, we before taking into charge certain clients, we equally notice that certain clients prepare 3 financial statements: one for the business owner, one for the bank, and one that they declare for taxes. But once you do 3 financial statements, at the end of the day, are you really sure that even the 3 that you are doing, they are coherent with your activity? Are you really sure that all the information are being inserted into those financial statements? And even if they are inserted into the financial statements, are you not using more resources to produce biased financial statements as to working in line with what has effectively been done in your business at the end of the day?
So before we go to an end of this program of today, I would like to know from you, and especially from BTN Advisory, what can you really say in terms of the warning signs or cash flow problems that might be coming to affect a small medium-sized enterprise, what can you really say to them for them to be able to identify these warning signs in order to prevent failure that might be coming from cash flow problems?
The first warning sign is having a cash flow that is frequently negative. It is bizarre, but at times we do the books of entities that when we are doing our monthly reporting, we notice that at times we have negative cash flow. Negative cash flow implies that there's no cash at all in the coffers of the business, that they are struggling to have cash. That's the first major warning sign. You don't need to be an expert to know that you don't have cash. Once you are constantly struggling to have cash, that is a very big red flag. That is the first warning sign. The second warning sign is, once as a business owner you notice that you are going from loan to loan, that is a very big red flag. That is, you are taking loan from A to reimburse B.
Okay.
Once B is being reimbursed, you take another loan from B so that you can reimburse C. You are only going from loan to loan, and the risk of going from loan to loan are the interests that are attached to this loan.
Okay.
Because in our today's world, there is no financial institution that will lend you money without having study fee for this loan, without having interest attached on this loan. Whether the loan is 1 day or not, there is an interest attached to it. So those are unnecessary expenses that you are putting into your books. That is the second red flag, the warning sign, as you earlier said. The third warning sign is, if as a business you don't have a budget, you are going straight to failure. No matter how genius you can be, you are going straight to failure. You must have a budget. You must know what are the fixed expenses that I must pay weekly, semi-monthly, monthly. What are the expenses that I must deal with for my business to continue operating? That's the first thing. The second thing is that what are the expenses that they are variable? Variable here refers to expenses that I can deal with if the possibility is there. It's not a must that I should deal with them. Yes, and if an expense becomes variable, it means that within a certain frame you can either minimize this expense, keep it to normal, or even increase it depending on the need of the field. Yes, so if you don't know what your budget shows regarding your expenses, you are going straight to failure, because at the end of the day, your objective as a business is to keep your revenues far above your expenses. So if you don't have a clear budget, obviously you will not know which expenses are eating much of your cash flow. So that is the third warning sign. And lastly, the last warning sign I would like to give here is, if you don't have an auto evaluation of your business. We don't talk about it in theory, is something really practical. You really need to sit as an accountant, because as an accountant, as a financial advisor, you should always try to put yourself in the shoes of the business owner, so that you can best anticipate what expenses might bring his business down, and equally, where are the sectors where if he invests or puts more of his energy, the business is going to boom. Because since I'm talking about expenses, but we really need to emphasize equally on the revenues. Because if your revenues are equally well calculated, if they are well anticipated, if you put in the necessary resources into obtaining those revenues, your business can boom as well. As I said, the race is between your revenues and your expenses. If your expenses are 1 trillion, but you keep your revenues at 2 trillion, you always outrun the profit that is there.
Yeah.
You get.
Yeah.
So that is the fourth warning sign. As I said, you really need to sit down as a business owner and do an auto evaluation of your business.
That's from time to time.
From time to time.
Is it like 1 week or 1 month, every month?
Every month. Okay. Every month you should sit and have a comparative analysis between what was realized last month and what is realized this month. It will permit you to easily track out where have there been a boom in expenses, where have there been a boom in revenues as well, so that you will know where to direct your energy into the business. Yes, so that is it.
Mr. Tekufan, it's nice having you on the program. I really appreciate you having time to spend with us on this program today. Small and medium-sized enterprise business failure inside the experience. It's all about talking about experience, like people like you that are in the field, seeing the reality is very important, and that's what the program is all about. Small and medium-sized enterprise business failure inside the experience. So see you next time on the program.